Hey guys, hey, if you want to know if we're in a housing bubble and if you're curious to know if the housing market's going to crash, watch this video. We're going to get into all the specifics. We're going to get into the data, show you not just what my opinion is, but show you what the data is actually showing us and what we think is going to happen over the next 12 months. So let's go ahead and get into the video. Hey guys, hey, my name is Justin Short. I am a realtor and I'm a team leader here for the Short Real Estate team in Murrieta, California, and I work here at Signature Real Estate Group. So each week we're making these videos and we're putting them out there for you for good content, hopefully keeping you updated what's going on here locally in the Murrieta, Temecula, Menifee Valley, keep you updated market stats, show you the differences between the different towns, and hopefully give you a good perspective whether you live here or you're even thinking about making the move here. So first, before we get into it, if you are liking the content, please go ahead and hit subscribe. Please like the video. It helps me. We're trying to grow the channel, trying to get more people watching. So I definitely would appreciate that. And it will keep you notified when we put out a new video each week on Thursdays. So thank you for that. So today we're going to talk about the real estate market. So the big question that I get from pretty much all my clients is, what's going on? Are we in a housing bubble? Is the real estate market going to crash? And today we're going to get into not so much what my beliefs are, and I'll tell you what we expect to happen, but more so what these data is showing us and what actually looks like on paper is going to happen. So we'll get into all the stats. Right now, I think most people probably are aware, it's definitely a big, huge seller's market. So it's supply and demand. There's not enough available homes for sale, and there's a lot of demand. So when you have that, and that happens for like a year, we start seeing that seller's market get in a very extreme seller's market. So in the other videos, we're talking about the stats, but the average home is selling in about 2 weeks or less. Homes prices are up significantly over the last year, and there's just not enough new listings coming up on the market yet. So huge seller's market. So that's the current state. And so people get worried about that. They kind of compare this time to say 2006, 2007, when it was also a big seller's market. And we know what happened in 2008, 2009. Well, the economy crashed, right? Everything came it was selling later on for 30% what it once sold for. And that's obviously going to be a big concern for a lot of people. So let's get into kind of some of the stats and show you what that looks like. So one of the big things that I do get asked about from my clients is just about forbearance. So if you don't know what loan mortgage forbearance is, the idea was if you had a struggle due to COVID that you could put your mortgage in forbearance. What that meant is you did not have a mortgage payment. So you got to make no mortgage payment for a period of time. Typically 3 months. Some people were allowed to extend up to 6 months, 9 months, or even up to a year. Some, depending on the mortgage provider, some people had to come up with all that money at once in one lump sum. Some people never had to pay that money and they just moved it to the back of the loan. So instead of a 30-year mortgage, it's a 31-year mortgage. So you had no mortgage for 12 months. So a lot of people did that. The concern is, well, now when they haven't been paying their bill, so now when the bill becomes due, if they can't pay it, that means they're going to get foreclosed on, and there's going to be a crash in home values, and there's going to be all these bank-owned homes that are coming up for sale, and that's going to kind of kill the real estate market, right? So, and that just does not seem to be really what's going on here. So there were 2.7 million people that did forbearance on their mortgage. So that's nationwide. So it's not just California, that's nationwide, which sounds like a lot of people. It's about 6% of people that had a mortgage. So about 6% of people did some form of forbearance. So that it could have been 3 months, could have been 6 months, 9 months, 12 months. So they did not make a mortgage payment for a period of time. So out of those 2.7 million people, right? So I have some of the stats. So when the forbearance ended, about 50% of them actually caught up on their mortgage and were current and totally paid everything off in full. So now we're looking at the other 50%. So the first 50, boom, right away, I caught up. They probably just took the free paycheck or the free lack of paycheck, for a few months, and which probably maybe not a bad business decision for some people, but that was really probably what happened for them. So you had those 50%, and then you have another big chunk, which is 35%, which had some sort of payment arrangement made out with the bank. So what that meant is maybe they had a deal where they're not going to pay the mortgage for 3 months, and they're going to move all their mortgage payment back to the end of the loan. That would be considered that. Maybe it would be, hey, I didn't pay my mortgage for 3 months, and I'm going to pay an extra $200 a month for the next 2 years until we catch up on that. Maybe that was a workaround. But there was some amicable solution between them and them and the mortgage provider. So basically 50% caught up, another 35% were in the clear, so that we're up to about 85% now of the people that did forbearance were pretty much taken care of, and that leaves about 15%. And the truth is that 15%, they are trying to figure it out. It's unsure what they're going to do. So they are maybe trying to do some sort of a refinance, some sort of a debt consolidation, or try and get some other sort of a plan. So that 15% that is actually a concern where they may not be able to make that mortgage. So they're going to have to look at other solutions. They may need to borrow money from someone else. They may need to be gifted money from someone else. They may need to sell their home in order to, because they can't make their mortgage payment, and go rent something in the meantime or buy a smaller home. So all those things could happen, but we're talking about 15% of 2.7 million. Not on the exact number, but it's probably about 400,000 people or so, and that's on a nationwide scale. So over 50 states, 400,000 people, even if they all went into foreclosure, then that's still not a lot. That's not a lot of people that are actually affected in that way in the grand scale, right? And the truth is, out of that 15%, almost all those people have a lot of equity, because all their homes have gone up in value quite a bit over the last year. They've all gone up anywhere from, in this area, 40 grand, 50 grand, 60 grand, 80 grand, 100 grand in the last year. So they all have that equity. So truthfully, what'll happen if they decide they can't make that mortgage payment anymore, what they're going to do is they're just going to try and put their home up on the market, and they're going to sell it. And they have equity built in. Even if they have to sell a little bit of a discount, it's not going to go to a foreclosure. They're going to be able to cash out and take their equity out of the home, pay off whatever other debts that they have, whether that's student loans or credit cards or any other, financial hardships that they have or responsibilities. You're going to take care of those, and that house is going to be really their gateway to be able to do that. So we are not expecting a big wave of foreclosures at this point, just because people have too much equity. We're talking about 15% of the 6% that actually did the forbearance, and most of those people have a lot of equity, so the increase in foreclosure is going to be very, very, very minimal. So that's what, from the forbearance standpoint, that's a question I get all the time. What about all these people in forbearance? Are they going to foreclose? And that's really what the data is showing us, is most people are in a pretty well-protected state. And so another thing that gets brought up by people all the time is, we know interest rates are really, really low. A lot of people are doing refinances. If you have not refinanced your mortgage in the last year, I would highly recommend that you do, especially if you're going to stay in your home for any length of time. I mean, interest rates on mortgages are lower than we've ever seen them. I refinanced my home twice in the last year personally, so I would definitely recommend it. Now, at the same time, when you do a refinance, right, you basically have two options. The more conservative and probably the best thing to do is just take your current balance, and you have a rate of, say it's 4%, and you're going to refinance it at today's lower rate to get a lower rate. So which means if your interest rate is lower, you're paying less interest, and your mortgage payment is lower, right? And there's very little fees to do that. It costs you very little over the life of a loan. So that's what we would recommend people can do. And alternatively, a lot of people, because home prices have gone up, home values have gone up, they have more equity, a lot of people have done what's called a cash out refinance. So basically that means, hypothetical numbers, let's say you bought a home for $400,000, you put $100,000 down, you owe $300,000, but now that $400,000 home is now worth $600,000, which is, we're seeing all the time now. So that's home worth $600,000, you still owe $300,000, right? And instead of just refinancing the $300,000, you're going to take a loan for $400,000. Now you have an extra $100,000 with the bank. They just give you the check for it. So you're going to pull your equity out of the home, and you can do whatever it is that you want to do with it. So you can go, and whether people can do just fun things, whether cars and trucks and all those types of things, or just put it away and better things, just invest it somewhere else. Invest it in a rental property, invest in the stock market, or do something else with it. But that's something we're starting to see more and more people do. And when we see that, obviously that is a concern, right? Well, does it make sense to take your equity out of your home and go put it into a boat? Probably not the greatest financial decision, right? Which is definitely true. So that's a concern is, hey, they say, Justin, hey, we're seeing more of our friends do cash out refinances, take that cash and go do something else with it. I think that's a really big concern. Maybe the home market's going to crash, right? That's what happened in 2006, right? Which, yes, it did, but it happened at a much larger scale back then. So back in 2006, we looked at how much home equity was cashed out by consumers. So in 2006, there was $321 billion in home equity that was cashed out by consumers. So that's nationwide. I mean, these are all going to be big numbers, right? But 321 billion. And they took that and people could do whatever. They could invest in a rental property, they can put in the stock market, or they can go buy a boat, buy an RV, go to Hawaii, do whatever they want, right? So the higher that number is, it can be a little bit more concerning. So, but 2006, again, 321 million. Compared to last year in 2020, we only saw $153 billion cashed out. So that's still a big number, we're talking about billions of dollars, but comparatively, compared to 153 billion versus 321 billion, that's about half as much equity was actually refinanced out. So what that means is people are keeping more equity in their home, which is good, right? Taking all that cash and going to buy a boat or buying the RV, again, not the greatest financial decision, right? So people, you can do that somewhat, which we're seeing, and you can consider it somewhat conservative, but if you get very aggressive with that, that's a big concern. So, and why that is, one, people have learned hopefully from their mistakes that they made 15 years ago. So that's a big thing. And then two, the banks are much, much, much more conservative with loaning money like that, especially on a cash out refinance. Basically, they make you keep about 20 to 25, some 30% of your equity in the home. So if your home's worth 600, they don't give you 600, right? If your home's worth 600, they may loan you up to like 480, right? So they're keeping quite a bit of equity there to keep the bank in a secure position, keep you as an owner in a secure position, and that also limits you, even if you wanted to take all that money, it limits the amount of money you're able to take. So that is good. I mean, those are rules and regulations to protect us from ourselves or consumers from themselves. Coming out of those refinances, the other thing to talk about is, well, what happens in the future, right? What can people do if they have financial hardship, or what else could they potentially do with their property? So we talked about a lot of people doing those cash out refinances. Now, so what the concern is, well, going forward, do they have any ability to do that again if they need a chunk of money, right? So when we look at is, one stat that I found was the amount of tappable equity available to homeowners nationwide, okay? So we're going to compare 2006, the amount of tappable equity, so that's the amount of equity that could be tapped into by a homeowner to do a cash out refinance, was at about $4 trillion, okay? So you're going to compare that to now in 2020, that's over $7 trillion. So what that means is comparing 4 trillion to 7 trillion, there's almost twice as much equity now that's sitting there available, which is good. So home values have gone up, mortgage balances are lower, so there's more equity available. Not only that, we're seeing people do it significantly less than they did back in 2006, right? So those are things that show us that people are being more conservative than they were, whether they want to personally or the bank is just making them. They're not making the same loans that they were back then, right? They're more secure financial positions, and those are things that should give you more peace of mind to know that the market, we're not going to see that crash over the next short period of time. So right now there's a high demand from buyers. There's not enough available homes for sale. Interest rates are very low. People want to take advantage of those. And the housing market seems to be on secure ground. When we're getting these offers on our homes, most people are coming in with big money down, $50,000, $100,000, $200,000, $300,000 down, or paying cash. So because of that, it's not like we're seeing like a no money down or very low 1% down or 3% down. That is not our typical buyer right now. Although yes, we can work with those people, yes, but most offers are big money down conventional, 20% down, 25%, 40%, 50% down, or all cash. And that shows you it's a little bit more of a secure market, and they're not bad loans that are out there. These are well-qualified people buying well within their means. Although we're seeing prices go up, yes, it seems to be a very, very solid and steady market. And really at this point, we're not expecting that market to change over the next year, 2 years. At some point it's gonna flatline, which I'm hoping that's gonna happen soon. Home values need to calm down a little bit, but we're not expecting to see that dip. We don't want to see the big increase going forward. We like it to flatline a little bit, make it a little bit more of a healthy market, and hopefully that's what we're going to see over the next couple of years with slight increases. So, hopefully the perspective helps. Again, I want to give you a little bit of my opinion, but mostly looking at data, looking what the facts are actually showing us. Hopefully it's a good frame of reference for you guys. If you have questions about your home value or values in the area, or what we think is going to happen over the next couple months, 6 months, year, feel free to reach out to me anytime. You can call, text, email. You're going to see all my information below. And hopefully if you're liking the content, please go ahead and hit subscribe. Again, we're going to keep the videos coming once per week, and it helps us and the channel grow. So appreciate the time, and have a good rest of your day.